So recently, there have been a lot of factors lining up that will create what I believe will become an even bigger market crash than what we saw in March earlier this year. After reading some research-backed articles, doing some of my own research, as well as my experience in technical analysis from trading, I believe it's safe to say that the current market is being artificially propped up by the Federal Reserve and is currently exhaling its last breath, leaving retail traders to hold the bag. Now, I know these accusations are wild coming from some kid just in their room on YouTube, but with my experience with trading stocks has shown me time and time again that the simple, probable outcome is generally more likely to occur. So if you've been following me at all on social media or are a part of TradeBuddy, then you know that I've been continuously saying that the markets were going to experience a significant downturn once COVID started to ramp up. I said this back in, January, late January. What I did not expect to happen though was for Powell to just turn on his money printing machine up to 11 and throw $5 trillion at the market to prop it up. And this obviously has led to the strongest rally the market has ever seen in its history. It gained over 47% in just about 50 days. And the overall amount of volatility that we have seen has drawn a ton of retail investors into the market, which is apparent by Barstool Sports founder Dave Portnoy's rise to FinTwit fame with his firm DDTG Global. Honestly, it's the perfect storm. People have been cooped up for months and have had no way to take on any risk whatsoever. No sports betting, no casinos, they couldn't do anything at all. So what better way to use your Trump bucks than to throw it at your Webull account and get 2 free stocks? The simple fact is that too many people are too excited about the stock market, and too many people believe that the stock market can only go up. Most of these new investors, myself included, have never experienced a real bear market. And no, I would not call the March 2020 drop a bear market, even though it dropped 20%. It lasted too short. Take a look at the SPY's trading action on June 10th, 2020. If you're any way invested into the broader markets, then you might have known that a highly anticipated Federal Reserve meeting was taking place, and the results of this meeting were to be released at 2 p.m. Eastern Time. One of the most critical pieces of information to come out of this meeting was regarding interest rates. Was Powell going to raise interest rates, which would have very much likely caused a widespread panic due to an increase in rates being a classic tool of contractionary policy? Or was he going to just continue course into the land of zero interest rates, a classic tool of expansionary policy and one that he has used repeatedly since he's been appointed to the chairman of the Federal Reserve? Traders all around the world sat anxiously waiting for their market watch feeds to refresh, and then it did. We're not thinking about raising rates, the Federal Chairman Powell said in the press conference. We're not even thinking of raising rates. Seconds later, the price action whipsawed down, taking out any weak hands who had stops under the pre-news price. Then massive volume flooded in. The whales are buying, Robinhooders said, and everyone who was waiting on the sidelines to invest into the market that seemingly only goes up just got their last bit of confirmation to finally buy in. Everything seemed great, but then only an hour later, the market closed red. The next day, we saw the sharpest sell-off since March, and financial news outlets painted a grim picture. Markets down 6% as investors faced grim outlooks of the coronavirus. So what had happened? The Fed meeting was insanely bullish. Interest rates staying near zero is a textbook bullish scenario, and we saw whales of volume flooding in after the news. Doesn't that mean it has to go up? No, of course not. In fact, I believe that the largest hedge funds and institutions knew that there was an exponential influx of dumb money who wanted to chase the Fed meeting. Looking at this price action, I see a ton of dumb money chasing the Fed meeting news just to provide the liquidity for the massive hedge funds and institutions to dump all their positions and then maybe even flip short. Shortly throughout the next few days, the S&P 500 briefly dipped below the infamous 300 mark, and then it bounced back. And this bounce ignited flames in the bull camp of investors. Powell's money machine is still kicking, and he'll do whatever it takes to keep the market afloat. However, people who have some experience with reading charts and people who have a grasp of supply and demand see the SPY chart differently. In fact, if you look at what happened during the early stages of the March crash, then we can see almost the exact same pattern. An initial drop followed by a bounce. However, the bounce was never able to retest the previous highs. And once it started to fall back down, investors, both institutional and retail alike, did not want to experience the pain of markets crashing again, and they sell in a panic. This leads to more people selling and even more people selling, and eventually causes a domino effect that broke the market down into new lows, and a full panic ensued. So now juxtapose that price action to what you're seeing now, and it's a very similar picture. You have investors, both institutional and retail, who are sucked into buying near the top of Powell's money printer rally. This is the people who chased the Fed Reserve news on June 10th, and they all held through a 25-point drop, down nearly 10% of their investment, and then because everyone has diamond hands, they were rewarded a hefty 15-point bounce. But because they have such diamond hands, instead of recouping their investment for a small loss, they thought to themselves, Powell's printer will never run out. I won't sell till SPY is at $400. And these bulls are very enthusiastic when the market's bouncing, but not so enthusiastic when they see weakness and eventual downturn. And since they don't want to experience the pain of being down 10%, they will likely sell, and then you have the domino effect continue on again. Now, obviously, the entire market isn't being driven by the mere actions of people who were trapped in that Fed news release, but this is simply a way of getting into the heads of the average trader and identifying how they think of the markets. Far too many people believe that this time it's different, and that the Fed Reserve will do whatever it takes to prop the economy up. Herein lies the issue though. While this may have been true the first time around back in March, many of those government programs that were created specifically to relieve Americans of the financial burden that COVID gave us are all ending right around the same time. Lots of the research in this part of the video comes from a fellow YouTuber by the name of Tom Heavey and an article taken from themostimportantnews.com, and both sources will be dropped in the link down below. Check them out. I highly recommend it. Basically, the article goes over 3 key instruments of consumer expenditure support that are all expected to be discontinued right around the end of July that overlap, and the CARE Act also being discontinued, causing people to simultaneously have to deal with increased expenses and a reduced income. As the article highlights, evictions have been temporarily banned, which has prevented many renters from paying rent and feeling the urgency to move out. I mean, think about it. If you didn't have to pay rent, first of all, you wouldn't pay rent, and you wouldn't want to move because you don't have to pay rent, so there's no reason to move. Most federal student loans have also been put on hold, removing one of the largest recurring monthly expenses that millions of people face on a monthly basis. And on top of all of this, the banks were also ordered to give their customers a 6-month break on mortgage payments if requested. Now, it's important to note that some states have given borrowers the ability on extending their break by an extra 6 months, but it's only 6 months. So once again, 3 types of expenses have been put on hold, and we can pretty much assume that most Americans are affected by at least one of these, if not 2. Not only have Americans had many large expenses put on hold, but the government has also been sending out over 159 million stimulus payments of up to $1,200 per adult, more if you have kids, and more than 20 million unemployed people have become eligible for an extra $600 a week on top of their $1,200 a month in unemployment benefits. So Americans have had a drastic cut in expenses, yet an increase in revenue, and some people have even claimed that they're making even more now than when they had a job. But unfortunately, many of these programs are scheduled to end on July 31st, with a couple extending into late September. And even though Americans have seen the largest monthly increase in household income during the month of April in history, it happened to also be the month that saw the largest drop in consumer spending ever recorded. In general, the economy doesn't grow if people are not spending money. And as the data shows, people aren't spending money at historical levels, even though they have obviously an excess amount of money on doing so. So this begs the question, what's going to happen when consumers don't have those extra protections? More specifically, what's going to happen when rent becomes due again, when student loans are due again, and when mortgages have to be paid? Obviously, no one can predict this for sure, but knowing what we know about economics, I don't think it would bode too well for the overall economy. And also, keep in mind, all this is assuming that we don't see another COVID-19 lockdown occur, which, at the moment, no one can guarantee. And there's new data coming in daily that COVID-19 infection rates are breaking out into all-time highs. And it's also saying that the western side of the US is experiencing faster infection growth than we've seen ever before. And if things keep going in the trajectory that they are, there's no reason to believe that a state like California would be willing to go back into lockdown mode. I'm sure they would. And Disney has just announced that they're pushing back their opening date. And Apple has shut down a few of their stores over virus concerns. I know Starbucks has done things too. And all this builds up to a scenario that would be truly devastating. How could the average American citizen even begin to cope through the next recession if there is no unemployment, no crisis payments, no rent forgiveness, no mortgage forgiveness, no student loan forgiveness, and on top of this, a brand new wave of lockdowns to throw Americans back into unemployment? Some people may say that the government will simply just reopen the programs if we were forced back into lockdown, but I wouldn't be so sure. America's national debt is reaching over $26 trillion, and we simply cannot be sure that Powell's printer has enough toner to print any money anymore. So do you think this scenario has any chance of happening? I would love to hear your thoughts on this topic as well. And also any counter arguments or pieces of information you have against the topic discussed. And please, if you enjoyed this video, I would really appreciate if you could hit the like button. It would help me a ton against my battle with the YouTube algorithm. With all that being said, I hope you enjoy the rest of your day, and I'll see you in the next video.